just start recording the session. Remember, in the previous class we spent most of our time looking at question 1, actually, that's the one we had. But as for today, I want us to look at question number 2 of the same paper. And so we are progressing from question number 2 of this same paper. Someone is asking, where are you getting that? This is the paper that we are going through. And so we are looking at question number 2 of this paper. This is what we want to do. I am reading in your hearing, an investor is comparing short-term and long-term interests, bearing interests bearing instruments that are issued by the government. So she observes that the yield curve is upward sloping and then is wondering what this indicates about future interest rates and investor expectations. That is what is happening. So an investor is comparing short-term and long-term interest-bearing instruments that are issued by the government. So she observes that the yield curve is upward sloping and now is wondering what this indicates about future interest rates and the investor expectations. The required being, explain the 3 main theories of the term structure of interest rates. Expectations theory. So what do we understand? What comes in our mind when we hear expectations theory? What about expectations theory? Okay, let me just change the marker, I think. Expectations theory. What can be said about this theory? Someone wants to give it a try? Or want to attempt this one? Someone is saying the volume is low. Is it the case with everyone? Is the volume too low?
From my side, I can get you clear.
Yeah, I think it should be from your end. You can try to, I think you can try to increase volume on your gadget. Okay. So now, about the expectations theory, someone wants to attempt this one. Do we have anyone who wants to pass a comment on this one? Okay, now listen. This one has it that the long-term interest rates, right? They do show the average of the expected future short-term, interest rates. You have not gotten this one. Let me write down. It posits, this is what it shows. It has it that the long-term, long-term interest rates, these long-term rates, reflect or they show the average, the averages of the average of the expected future short-term interest rates. Okay, so what this means is that if the investors say they expect short-term rates to rise, for example, the investors are expecting the short-term rates, interest rates to rise, then what shall happen is that, of course, rise in the future, then the long-term rates will be higher than the current short-term rates. Okay? You have not gotten, I'm saying that if the investors are expecting, these short-term rates, let me just say, right, ST, short-term rates to increase in the future, if they expect that these short-term rates would increase in the future, then what will happen is that the the long-term rates, will be higher than the short-term rates. In short, the long-term are going to be high. Yeah. So the long-term rates will be higher. They'll be higher than the short-term ones. The short-term. In other words, they will just increase. So what will happen is that if you are checking about, or you are relating this also to the yield curve will be upward sloping, because I will show you when you go to question B actually, where you need to show the graph. So graphically, the yield curve will be upward sloping, showing that the future interest rates as time goes on will start rising. Why? Because we are expecting the interest rates to rise. In short, it's just some psychological, it has some psychological connotation, where the people are expecting, if people expect the interest rates to rise, then in their decision making, they start factoring all that. Then generally, you just find the interest rates in the future start rising. Why? Because people projected the interest rates to rise. So this is what the theory of expectation, the expectation theory says, of course, in relation to interest rates.
Maybe you can do a recap. I am
Hello?
a little bit behind.
You have any question? Is there any question on the
maybe just a recap? I'm a little bit behind.
So we are saying, madam, the expectation theory, it posits that the long-term interest rates reflect the average, of the mean or the expected future short-term interest rates. So what that simply means is that if the investors, for example, expect the interest rates, of course, the future interest rates to rise, what will happen is that the long-term interest rates will increase as well. Why? It will ride on the expectations of people. Practically speaking, we're saying if people generally expect the interest rates to rise, they'll factor in that in their decision making, and you'll see the interest rates generally increasing. That's the message we are sending. We are good?
Yeah.
Okay. We can now go to liquidity. Yes, sir. Yes, sir. You can go ahead.
A downward sloping, when we have a downward sloping curve, it means we expect the interest rates to go down.
Yes, it shows that the interest rate, you put it here, then the years, like the time, you put it down, right? So what will happen is that as time is increasing, then we expect that the interest rate will start falling. So that's what the message is sending. You'll see the graphs when you get to B. Okay? Thank you very much, Pat, for that one. Now let's get to liquidity premium theory. What does this one say? Okay, this one is a little bit interesting. What does it say? This is what it says. Liquidity premium theory has it that, actually this one is an extension, of the expectation theory. Okay, it just adds the liquidity premium part of it. All right. So what it says is that investors would demand a premium for holding long-term securities because they are riskier and they are less liquid. That's what it has. Let me write down. What are we saying? The investors, right? The investors would demand, what are they demanding? They are going to demand, they will demand premium, which is compensation, right? They will demand premium. In short, they will demand higher interest rates, right? Above the average interest rates. They will need an additional, on top of that. That's the premium we're talking about. For holding the long-term securities. Long-term securities. Why? Because long-term securities are riskier, right? And they are also less liquid. Maybe for you to pick this one, let me get back to be a little bit practical, so that you can understand. Look, the interest rate that you earn on a 2 years bond, government bond, cannot be the same as the one you earn on 5 years bond. You get what I mean, eh? Why? Because a 5 years bond is a long-term instrument. 5 years are a lot of years, and investors need to be compensated for that. The period is just too long. So you find that the interest rates are higher for those very long-term, securities. I've just given you an example of the bonds so that you quickly get it. So you find that, Kyle, you are lending your money for a long time. You get a point, right? Since you are lending your money for a long time, you'll not be with your money for a long time. You demand higher premium, higher pay, higher compensation, for giving your money or for sacrificing your money for a long time. And again, these are said to be less liquid, which means you can't easily sell, them on the secondary market. They are not easily sold. Yeah, they can be sold, but the key word is that they are not easily, underline the word easily, sold. So this is the message that is put by the liquidity premium theory, okay? So what will happen now is that even if, for example, you have the future term rates expected to be constant, the yield curve will still be upward due to this premium. You get the point, right? We can expect that the interest rates will be constant, they will not change, but since the people were demanding some premium, you see it again rising and start shooting. So that's the message we are sending. Is that clear? I guess you picked that one, right? Liquidity premium theory, it just has that postulation where investors demand premium for holding long-term securities. Why? Because they are riskier and they are less liquid. Is that clear? Any question from someone? Can you confirm you can hear me clearly? All right. If you can hear me, that would be fine, but you haven't yet confirmed.
I'm getting you clearly from my end, sir.
Thank you. Market segmentation theory. Now let's get to market segmentation theory. This one. What does it really argue? What's the argument from this one? Interesting. Now this one, argues that the market for bonds is segmented based on the maturity preferences of investors and borrowers. Okay? You have not heard. So it argues that the bond market, right? Remember, you have the capital market, the equity market, and the bond market. The bond market is segmented or is divided, whatever is categorized, whatever term you'd want to use, it is segmented or categorized, based or classified based on what? The classification is based on the maturity preferences, right? The maturity preferences of who? Of the investors, probably, and the borrowers. In short, this is not really supposed to confuse anybody. It's just about how long is the tenor of the bond. Remember, the bonds have tenors, right? They have tenors. We have 2 years bonds, 3 years bonds, 5 years. I'm citing an example of Zambian market, bond market. 5 years, 7 years, 10 years, 15 years maximum. Okay. So we are trying to say that this bond market is segmented based on this. You get the point, eh? It is segmented based on that. So what will happen is that the interest rates are different, okay? These interest rates are different, but they are fully determined by the supply and demand within that particular segment, not by expectations. You get what we mean? You have not gotten this one. So the message here is that the interest rate here is based on what? It will just be based on supply and demand, you know, and demand of the bonds that are in that segment. Maybe 2 years bonds. So how much supply is there? How much demand also is actually there? That is what will determine the interest rates, not the expectations. Whether you expect the interest to rise or fall here, this will not really matter, will not affect anything. According to this theory just says that it is actually according to that particular segment. Okay, so that is what will determine the interest rates. Okay. You have also learned that, for example, if you have more demand for short-term securities, right? Those that are short-term, short tenors, right? Their yields will be lower, okay? And the opposite is true. You get, if the tenors are short, for example, it's 2 years, the interest rate is, I think we are sending the same message again. Anyway, you see, they are the same theories. These are just related theories. If the tenors are short, for example, it's 2 years, the interest rate will be just, they will be low, okay? But if the tenors are long-term, they're in that segment for long-term, for example, 10 years bonds, the interest rates really look to be so much. Yeah. So that's the message we are sending across on this. Is there any question? Confirm you can hear me. Okay. Well, let's get back now to B. Let's get to B, where we are taught to illustrate using diagrams on how each theory explains the shape of the yield curve. So we want to use diagrams now. Let's start with the expectations theory. Okay, the expectations theory. How is it going to be? Okay. Let me start with number 1. Let's say we are expecting, if we are expecting the interest rates to rise, isn't it? We expect them to rise. What will happen is this. On the vertical axis, you put interest rates, all right? Then that's the yield. Then here you put the maturity, the periods. Okay, let's say this is 0, 2 years bond, 3 years bond, 5 years bond, 7 years bond, 10 years, 15 years bond. You get what I mean, eh? So if we expect the interest rates to rise, then the curve will be like this. It will be upward sloping, okay? It will just be hypothetic like that. This is the yield curve. Is that clear? So we expect that as the years increase, as the tenor increase, as the maturity periods increase, this is what will happen. The yield curve should be upward sloping. Do you have a question on that one? No, sir. It is clear. We get to the the other one, when the interest rates are expected to do what? To fall, right? Then it's the same graph really. You already know these things. It will be downward sloping like that. This will be the yield curve. So expect that as the time goes on, as the maturity goes on in the future, if you expect the interest rates to fall as years go on, these are years, then you will see that the curve will start falling down, which is the yield. The yield is falling down. That simply means we expect the interest rates to fall. Okay. Afterwards, what if it's flat? Flat, right? Then at that point, we don't expect the yield rate to change in any direction. It will just be constant like that. This is the yield rate. Okay. So that's a bit about the expectation theory. Now we get to liquidity theory. The liquidity theories. These ones are interesting. These are always upward sloping. You get always upward sloping. If we expect, there are no expectations here. The issue is that since the people are always asking for the premiums, you find that the yield will always be higher. Like the interest rate which will be charged will always be higher. Even if we expected the interest rates to be flat, still it will increase. Like the rates will be higher because the investors are demanding something that is high. That is about the liquidity premium theory. So that the curve is always upward sloping. Okay. Now, maybe to summarize, we can also pass a comment on the yield curve for market segmentation. All right. We said that this one will be dependent on the supply and demand in each maturity segment. So let's say, for example, you have the demand, you have high demand for short-term securities, right? Short-term securities, there is high demand for them. And then there is low demand there's actually low demand for long-term ones. So what will happen is that the rates, the yield rate will be actually, the curve will be, it will just be upward sloping and it will be a steep one, like this. It moves like this, it is showing you that in the short run, there is more demand for the short-term securities, and they give that rate as compared to the other demand. So basically, as compared to the other tenants. So basically, this is the message being sent across. Now, before you leave the class, there is this part C of the question, which is saying, discuss how central banks and investors use information from the yield rate in forecasting economic activities. How does it work? Let me start with the central bank. Okay.
Hello, sir.
Hello?
I have a question, sir, on
Yes, sir.
on B.
Yes.
So if this question came in the exam like this, does it mean we are supposed just to write to illustrate just 3 diagrams based on the 3 theories? For example, like for expectations theory, just one diagram. Liquidity premium theory, one diagram. Then market segmentation theory, again, one diagram.
Yeah, even if 3 diagrams would suffice, coupled with some explanation. Don't just draw a diagram. So, for example, under expectations are segmented into 3, right? You can expect it to rise, fall, or be constant. So, if you choose the one for rising, you should put notes there that this is a case where, we expect the interest rates to rise, so that at least your examiner may understand. But most of these are single. The remaining are usually single scenarios. You can pick it like that. But the question is says how each theory, which means you need to present all the 3 theories. Hope you're fine. Okay.
Yes, sir. Yes, sir.
Now, how central banks use. So let's start with the central banks. Okay. Usually, the central banks use the yield curve as a leading indicator for economic activities. And so the interpretation is that if you have, for example, an inverted yield curve, okay, the inverted one, that's a down one. So it means that the short-term rates are basically higher than, the long term. You get what that means? Like if you get the inverted one, it means that the short-term rates are higher than the long term, which means you're not getting what we mean by inverted. Remember, we drew it like this. It was sloping like this, and by inverting, we mean like this. You're moving like this, which means that there are higher interest rates for the short term. You get what I mean, eh? The period, which is shorter, and the interest rates are reducing in the long run. I think you pick that message that we are sending. What this may signal now, the interpretation, is an upcoming recession. All right? This may signal an upcoming recession. It may signal an upcoming recession like that. But what this does is that it helps these guys, the monetary policy guys, to make changes in their interest rates, because they are the ones that set the policy rate and so forth. So basically, that's what happens. What about investors? The investors use the yield curve to just assess the future interest rate movement and some economic expectations, right? So for example, if you have an upward sloping, that would suggest the economic expansion and rising inflation expectations as well. You know that if you expect the yield rate to be increasing, we expect that the economic activities are booming, right? So that is what that would signal, and that's some of the message. That's the message that would be sent to the investors, basically. And if you have the opposite one, it would also help the investors pick the message just like that. So basically, this is the message we are sending across.